Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everyone, and welcome to this January 3rd, 2024 edition of Trading Places live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and it's a pleasure to be with you here for the next 30 minutes or so as we get ready to open the market. Yesterday, first day of 2024, not a great day for growth stocks, but not bad for value. We saw a little bit more rotation from growth into value. That's not completely unusual. We certainly see a lot of that at the end of calendar years, and occasionally we do see it trickle into the following year. Also, I think it's important that we see a broad participation in the rally. It's healthier, no doubt about it. And so it's good to see other areas beginning to catch up, because many of the areas that are performing well now really struggled on a relative basis. Some of them actually going down in 2023, while many of the tech names and consumer discretionary, communication services, those areas took off. Some of these other areas lagged pretty badly. And so we're getting a little bit of a catch up, which isn't bad historically if you look at it using some perspective. So all in all, I think action yesterday, even though we got off to a rough start with growth, some of the big technology names, I'm not too worried about that at this point. I think we will see a move back into those stocks when the time is right. Whether or not that's today, whether it's next couple of days, next week, I don't know. But I do believe we will see rotation back into that area. I do want to mention that we do have our Market Vision 2024 event coming up this Saturday. It's just 3 days away. If you can head over to EarningsBeats.com, there is a charge for non-members, but it's completely free to annual members at EarningsBeats.com. So this is a great opportunity for anyone to come into EarningsBeats, sign up for our 30-day free trial. A couple of advantages. Number one, we're having an event on the January effect tomorrow after the close. So that's Thursday, January 4th at 4:30 p.m. We will be having our January effect webinar, and that's available to any member of EarningsBeats.com, even those just on a 30-day trial that haven't paid a dime. So this is a great time to come in. Check that out. January has been unbelievably accurate in predicting how the rest of the year is going to go. And I'm not talking about the rest of the year, including January. I mean, obviously, if January goes up 10%, there's a pretty good chance the balance of the year is going to be strong because you're starting off with a 10% gain. I'm not talking about that. I'm saying if you start off with a strong gain like that, the balance of the year tends to be very strong. And I've got the numbers to back it up. It's really amazing when you take a look at this. So we have this as one of our lead up webinars heading into Market Vision 2024, because it is something that you should be considering when you evaluate the balance of 2024 and what we might expect. So again, go over to EarningsBeats.com. I'll give you a little bit more information on that a little bit later in the show, but definitely check that out. As far as Saturday goes, it's going to start at 9:30 in the morning, probably go till about 2:30 in the afternoon. Got a few different sessions, and we do have an area on our website where you can check out, get more information, register. And again, I'll go over that with you later in the show. Finally, again, thank you all so much for your support in 2023, whether it be via membership at EarningsBeats, which obviously is what keeps us going, or whether it's just support here on YouTube, following our shows, following my blogs over at stockcharts.com. Certainly appreciate that. We've got an EarningsBeats Digest newsletter, which is a free newsletter. If you're a part of that, thank you for that. Really what we're trying to do is just help give back to the community. And if you find out that, hey, we're helping you, we'd love to have you come on board as a member and support us. It keeps all of us. It's not just me at EarningsBeats. We have 6 of us, small team, but very efficient, focused on customer service, research, guidance, all the various things that hopefully help you all navigate the market better. So keep that in mind. Actually, one more thing before we get into today's show. Keep the likes coming on the video. Also, subscribe to our channel if you haven't already. That really helps us in a way that maybe isn't monetary by becoming a member, But if you can like and subscribe to our YouTube channel, that would be huge for us because it just helps us in the YouTube algorithms get out to more and more folks. So with that, let's go ahead and jump into the action from Tuesday to kick off the new year. Now, I'm using the same candle glance charts that I used yesterday for a reason. I want to show you that the leadership that we saw yesterday came from areas that didn't participate in 2023. And where we saw weakness, those were areas that we saw tremendous strength in 2023. So it's just one more way to see how this rotation is taking place, or at least has started to take place here in early 2024. So let me first go over the Dow Jones Industrial Average, which yesterday gained 25 points. The S&P 500 fell 27 points. NASDAQ clearly under pressure yesterday, down 282 points. That was almost 1.7% on the index, which clearly much higher than the S&P 500 in terms of loss on Tuesday. And again, the Dow Jones actually was up a little bit, a fraction. Mid caps down about 1/3 of 1%. Small caps down about 0.6 of 1%. So neither one of those did well, but they more, tracked the S&P 500 rather than the NASDAQ. And then we had the transports down about 0.8 of 1%, pulling back. But most of these areas, actually all these areas that you're looking at, they're all trading above the 20-day moving average, which is trading above the 50-day moving average. We are back in a very bullish configuration on the market, and I don't think that should be ignored. Moving on to the sectors. So healthcare, which had a really nice day yesterday, up 1.7, well, basically 1.75%. Utilities up almost 1.5%. These are defensive areas. So you've got your 4 defensive areas. You've got healthcare, utilities, consumer staples, and real estate. Those 4 areas did much better than their aggressive counterparts yesterday. And I want you to look down below here at the bottom. This is the 52-week rate of change. Now, when you go up and you look at the Dow, you see 14%, S&P 23.5%, NDX 51%. But if you look at the healthcare group, 3.86, and that included 1.75% yesterday. So, I mean, going into yesterday, we were barely above the zero line. And it's okay to have rotation and have money move into some other areas to kind of pick things up a little bit while some of the areas that have had massive gains pull back. People decide to take profits from time to time. The good news is that all the sectors didn't go down. Instead of money coming out of all sectors, what was happening is we were seeing money come out of some of those aggressive groups and filter into some of the more defensive groups. And as long as that's on a short-term basis, and certainly when it happens when the market pulls back, that's fine. What I don't want to see is the market going up 10% and being led exclusively by the defensive groups and some of those aggressive groups not participating. That would be an indication of something we would need to worry about, perhaps a bear market. That's not what I'm looking for at this point. I'm going to go over more at Market Vision, 2024. I'm going to leave it at that. I'm not going to get into 2024 just yet. You got to be there on Saturday for this one. But healthcare clearly strengthening, did make a breakout right here above recent highs. I think it's in a position to go higher. Whether or not it leads on a relative basis, I don't know. We'll see. But in the short term, I wouldn't be shocked. The utilities group, you can see also moving up, clearing its 50-day moving average for the first time since we were all the way back in July. So that's on an absolute price basis. And then down here below, look at the 52-week price percentage change, down 5.83% over the last 52 weeks. We've had a huge rally in the markets. Utilities have not performed. Not only have they not performed positively, but they were negative. They have been way underperforming the market. Down 5% versus the S&P going up 23%. That's 30 percentage point underperformance. So you're going to get rotation back into these areas. Remember, rates have been coming down. So when rates come down, utilities generally look more attractive. And you can see since October, we have seen utilities going up, but just on a relative basis, we have not seen the strength that we'd like to see there. But again, in the short term, we could see some additional money moving into some of these defensive areas. Now, what didn't work yesterday? Well, the big group that didn't work was technology. all the individual industry groups within the technology sector, all of them were down. Computer hardware, which is home to Apple. You've got semiconductors, think NVIDIA, Applied Materials, KLA Corp, AMD, Texas Instruments, Intel. Think those types of stocks. They're all in the semiconductors. Computer hardware and semiconductors were awful yesterday, both dropping about 3.5%, leading to technology's drop of 2.6%. So, but look down below. Look at technology, up 52%. S&P 500 was up 23%. So again, it was the massive leader in 2023, the defensive groups, the massive laggards, and we just saw a flip for a day, which is better than the money coming out of technology and coming out of everything else as well. So we were seeing some rotation. Rotation is extremely important in a bull market. Extremely important. I can't overemphasize. When money is coming out, when we're in a bear market and you look at on down days, everything goes down. Pretty much everything goes down. Yesterday, I know when I did my daily market report, which was late in the afternoon, 6 sectors were higher yesterday. You look at the S&P, it was down 27. You look at the NASDAQ getting crushed, but it was mostly because of those groups that had been leading. We saw profit taking. The profit taking, though, rotated into some other areas of the market, which I think is really good in the short term. And when the market's going down, don't confuse that, because a lot of folks, come back later and say, well, rotating into defense, you said that's a topping signal and the market keeps going higher. What's going on? First of all, that money rotating into defense needs to happen when the market's going up, number one. And number two, we need to see that rotation last for a while, not just for a couple of days or even a couple of weeks. We need to see a solid month of money pouring out of offensive, aggressive areas and into defensive. That's what we saw back at the very end of 2021, before we actually did get a bear market. Go back and look at the 2021. Go back to my blog, go into archives and look at the article I wrote. I believe it was on December 31st of 2021. While everybody else was partying New Year's Eve, I was writing another article, because that's what I do. I love the stock market, and that's how I party. That's not really how I party, but I do like to follow the market, and I think you all know that by now. But anyway, go back and read that article. I pointed it out going into 2022 that we had a month of massive rotation, and the market was trekking just a little bit higher. It was almost like it was trying to go up, but it was being held back, and it was being held back because of that negative, bearish rotation that took place while the market was still trying to move higher. Anyway, I'll talk about some of that more at Market Vision 2024. One of the early sessions that we have, I'll actually be talking about the difference between bull markets and bear markets and what you should look for ahead of time and during these bull markets and bear markets and what sets them apart. That's going to be just one piece of Market Vision 2024. So anyway, make sure you tune in for that. All right, looking at the industry groups. So what didn't work in 2024? Or excuse me, what didn't work in 2023? Food products. Look at them, down 7.21% over the last 52 weeks. Pharmas were flat over the last 52 weeks. Again, compare that to the S&P 500, which gained 23%. I always like to compare things to the S&P. That's my benchmark. If I can beat the S&P 500, I'm a happy camper. I mean, that's what just about every portfolio manager in the world tries to do. They try to beat the S&P 500. So if we can beat the S&P 500, great. And how do you do that? By investing in areas that beat the S&P 500. It seems pretty easy. Not always quite that easy, but if you were in food products or pharmas last year, you were being dragged down. Whatever you had invested in those areas were hurting you in terms of your relative performance. So you want to be in areas that are leading in order to better your own individual performance. But food products, pharma's not really participating, but look what's going on this year. Now we've got food products breaking back up above the 20-day moving average. Had not seen that since back in July. First time in 5-6 months. Kind of a big deal. We saw pharmas make a big breakout, moving to the highest level it has been since probably back in the second week of September. So this is on an absolute basis. And we're starting to see that turn back up again, looking back over a 52-week rolling period. All right, recreational services. Last 52 weeks, they've been up 64%. Stock, this area was down 5 2/3% yesterday to open the year. Now we have some overhead resistance. We failed there. Probably, I would be looking for some of these areas that have been flying to maybe find some support if and when they get down to the 20-day moving average. That would be the first thing that I'd be looking for. But recreational services, can't argue with it over the last year. Still up, even with yesterday's loss, still up 64% over the last 52 weeks. All right, let's keep moving. TNX. Before we get into this, and I'll give you a quick update so we can see where we are right now. I will tell you that the futures are red again today. We've got Dow futures down 142, S&P 500 futures down 22, NAS futures down 111. Again, NASDAQ futures down more than the others. So it looks like maybe some of the technology areas, consumer discretionary, may be in for another day of selling. Crude oil up fractionally, up about 0.75%, back to about $71 per barrel. 10-year Treasury yield, as you're looking at right here, 3.988%, getting back up close to 4%, close to that 20-day moving average, which currently is at 4.01%. Notice since this head and shoulder top from back in October, early November, we have not been able to get through the 20-day moving average. So if you're looking for more sideways consolidation in the 10-year Treasury yield as opposed to a downtrend, first thing needs to happen, we got to get through that 20-day. 4.01 is the level to look for there. Also, a couple of economic reports coming out later this morning around 10 a.m. We do have the ISM Manufacturing Index. We're expecting that to trek up a little bit of numbers. I think we're around 46.5, and I think we're looking for 47.5. I believe that's about right. JOLTS will be out also at 10 a.m. The JOLTS really centers around new job openings. So new job openings, I looked at the estimate. It's expected to rise slightly from 7.3 or maybe close to 7.4 million openings to about 7.5 million openings. And then later this afternoon at 2 p.m., we get the FOMC minutes. So this is the Fed basically coming back and summarizing what they talked about at the last meeting. Sometimes you'll see something that is maybe new, or maybe investors maybe view it a little bit different than they had previously. But generally, this is old news. The Fed over the last many, many years has tried to become more and more transparent leading up to the Fed meetings. And so getting this information a couple weeks after the Fed meeting generally doesn't lead to a whole lot, but it's out there. 2 p.m. If you see the market make a big move one direction or the other at 2 o'clock, maybe there's something in the Fed meetings or the Fed meeting that caught their eye. All right. Anyway, 10-year Treasury yield continues to be on the downtrend. Like I said, I think that 2024, giving you a little bit more info, I think the 10-year Treasury yield is going to be in a range. I don't believe we're going back through 5% in 2024. I think that was a top that we saw form here with a negative divergence. We came back down, busted through. The Fed has talked about being much more dovish in 2024 with rate cuts on the horizon. I don't think that the 10-year Treasury yield is going to go down in lockstep with every one of the rate cuts, though. I do think that the 10-year Treasury yield was built up and inflated a little bit because of inflation. And now that inflation is not really a big thing, I think it's quickly being deflated, that little bubble there in the yield. And so I think we're going to be somewhere, I'm going to say 3 to 5%. I think we could go as low as 3 this year, but I don't think we'll go below that. And as far as 5% being the high, I don't know if we'll go up and touch that or not. I just don't know if there will be enough. There's going to have to be some signs of still inflation kind of rearing its ugly head at some point to get folks to start selling bonds and requiring more yield. So I don't think the 10-year Treasury yield gets back up there, but I think the only thing maybe that takes it up there would be reigniting inflation to some degree. Instead, I'd probably be looking more 3.5 to 4.5 in that range, with maybe the outliers being 5% upside, 3% downside. S&P 500, let's keep moving. S&P, it's pulling back. My gosh, we haven't had a 20-day test yet. We've been going straight up since the end of October. And by the way, October 27th close, from there to January 18th close, that's the most bullish time of the year. Historically, there's no other 2-month, 2.5, 3-month period even close to what we normally experience. And that's what I said back in October. You've got to be careful, because if you're going to bet against the market going into November and December, you're going to be betting against history. Of the last 73 years, the October 27th close to January 18th close has produced gains. Of those last 73 years, this period has produced gains in 62 of the 73 years. Only 11 times have we not gone up from the October 27th close. And if you look at it, and I've talked about this plenty of times, it's like a water spigot, that you're going, you have completely ice cold water for that week leading up to October 27th. It's the worst week of the year historically. And then we have the best 10-day period that starts October 28th at the open, all the way through November 6th. And look at what happened. I mean, here was the bearish period going down, and literally we flipped the faucet from cold to hot water on the 27th at the close. There was nothing else in the market that I saw that pointed to this kind of a big reversal. It was the only thing I could think of was history. And there we went, right back up again, starting on October 28th. Pretty amazing. The other thing about bear markets, I would say, and this was not a bear market, it was just a correction, but 7 of the last 14 bear markets have ended with the low being in October. 7 out of 14, 50%. There's 12 different months. You would think every month would have about an 8% chance of being the month where the bottom occurred, right? October, 50%. 50. 1 out of every 2 bear markets ends in October. When did the bear market end in 2022? October 13th. When did the correction end in 2023? October 27th. October is a month where we tend to see whatever, I think it's the optimism. I think it's the holidays. I think it's an optimism for the new year. Keep in mind the stock market, while, you get bears that are always bearish about everything. The stock market over the last 72 years has gone up, well, now 73 years, has gone up 55 times out of 73 years for the year, calendar year. So as we go into 2024, if you think the market's going to be down, or you think it's going to get crushed, you're basically on the side of the 25% of the time when we see the market go down for the year. 75% of the time, 75% of the years, it goes higher. So just without any other knowledge, just the historical knowledge, just know if you're bearish going into 2024, you're fighting an uphill historical battle. Make sure that you got other things, a lot of other things to corroborate that bearish theme, because market history tells us that we want to be long unless we can be convinced otherwise. 2022, I was convinced otherwise. If you remember from Market Vision 2022, said I did not say we would have a bear market. I don't want to take credit for something I didn't say. What I did say was there was tremendous amount of warning signs. The risk of being long was too great, and that if price action were to start rolling over, that would be the last straw to confirm a bear market was underway. And so when we saw that weakness throughout January, that was your confirmation. Anyway, I'm not seeing those signs. Not everything's perfect. And again, we're going to talk about that on Saturday. But just keep history in mind. If you're going to bet against the stock market, you better have good reason. Okay, let's see. Still got about 5 minutes or so to go. Let's go through a couple of these other charts. So we got the NASDAQ, same thing. we are down to 20-day moving average. We have great support, I believe, down at about 16.1 in terms of price support. That's where we broke out December. I don't know if we get down that far before we get a reversal. Notice that the gaps, this is the other thing, is this distribution or is it manipulation? Yesterday, yes, we went down. The majority of the losses came at the opening bell, though. We've seen this tune before. Just saying. Today, we're getting another gap down. If the majority of the selling is gaps, that's not distribution. The big firms, Wall Street firms, how much liquidity is out there in after hours and pre-market? Do you know how much money needs to shift and rotate for Wall Street firms to get out of the market or to fully reposition? I can promise you they don't do it on gap downs. There has to be selling throughout the day. They have to be actually selling something. You can't do it after hours. Market maker participation is limited. Liquidity is not good in after hours. Wall Street, the big, Goldman Sachs of the world, they're not selling in after hours. You can't sell millions and millions and millions of shares in after hours. Sorry. So the gap downs are, really what you want to see as if you're thinking about maybe the market topping, and it's another bearish signal, is you want to see gap ups and then selling. You want to have gap ups and folks pouring in the morning to provide the liquidity so the big Wall Street firms can sell and get out. They don't get out by gap downs. Anyway, that's just one day. And we had a couple days selling at the end of the year. We'll see how this goes. But gap downs make me look for reversals. Let me just say that. IWM, moving up, very solid. Finally got through this 198, 199 area that had been torturing longs. Kept going up, kept failing, kept going up, kept failing. Well, finally we busted through in the second half of December. Now we're pulling back a little bit. I think the first key area, 195, 196 on the IWM. We're 199.52. I know futures were down this morning. Maybe we're going to see that 195 or 196. Maybe we'll touch it today or within the next couple of days. I don't know. That would be an area to watch for me there. Transports pulling back, already getting down close to the 20-day moving average. I think you've got some gap support in here to watch. Most recent breakout probably at about the 15,550 area. And then you've got a lot of this gap support. So we've got maybe 225 points before I'd say we're hitting some really key support, and breaking down below that obviously could lead to some additional losses. All right, chart of the day. Before I get into that, I just want to tell you, here is how you can start your no-cost trial. Click on this button. It's $0. You do have to give credit card. We have to get you set up in our system, which requires the credit card. But it's $0, and we will remind you before your 30 days is up. If you don't want to continue, we don't want you to continue. But check that out. And if you are any kind of a member at EarningsBeats, including trial members, you can come to our January Effect event, which is tomorrow at 4:30 after the market closes, 4:30 p.m. Eastern. So all you got to do is sign up, be a trial member to come into that. It'll be worth it, trust me. When I found out what impact January had on the balance of the year, I think you got a lot of folks making their bets. They've got, these Goldman Sachs firms and Morgan Stanley and all, they hire the best, the smartest, the brightest out there from the Ivy League schools, best schools in the country. These are smart people. I'm not a big fan of these firms because I think they're greedy. And I think they take advantage of you and me, but they are smart. And I've never questioned how smart they are. And so they look ahead. They've got great economists. I think January sets us up, and I'll show you how tomorrow, but you need to be at least a trial member for that. Then we've got Market Vision 2024 coming up on Saturday. And I'll tell you, this is going to be a big event. You can scroll down. Here's the agenda. That's the anatomy of bull and bear markets I was talking about. What about the presidential election year cycle? Know anything about that? I've done the research. I'm going to let you know what happens during an election year. Then we've got Grayson Rose joining us from Stock Charts. He's going to talk about the evolution of stock charts, the next evolution, the new Sharp Charts workbench and so forth, the platform that we use. There's some changes, and Grayson's going to go through it, talk about how he's using it in his trading and some of the big changes that have come along. And then the forecast. I'll go into that starting at 1 p.m. Eastern. I say, probably go to about 2:30. I'm thinking 90 minutes. I tend to be a little bit long-winded, as you might know, now that we're at 9:30 and I'm still not done the show. But that's unfortunately one trait you just have to put up with me, with me. But I'll be talking about a lot of different things on Saturday. Hopefully you'll join me. I think it'll give you a really good roadmap of what you can be looking for, and some of the things maybe that I will be looking for that maybe you'll tell me that I'm wrong, because I don't have a crystal ball. I've had a good track record at these events, but I don't have a crystal ball. So I'll be looking at things that, hey, if this happen, this forecast could be shot. But I don't believe that those things are going to happen. It'll be kind of something along those lines. But I've got a really interesting target for you at the end of 2024. So make sure you tune in for that. All right, let's move on to the chart of the day. So Goldman Sachs was my chart of the day. I just pulled up a long-term monthly chart going back 25 years here on Goldman Sachs. And you can see lots of volatility. I mean, during the 2000 to 2002, it was a dot-com led market crash, or market secular bear market, if you will. But Goldman Sachs certainly went down during that. Here was the financial crisis. Obviously, the financials all got absolutely crushed, and Goldman Sachs was no exception to this rule. And then we had the 2018 trade war. You can see there pulling back, and there's of course, the pandemic. There's the 2022 cyclical bear market. But when we're not in those bear markets, Goldman Sachs tends to be a pretty good stock to own, pay a dividend. And here you've got a key resistance level coming up at 400. So what I'm watching for on Goldman Sachs, because when this stock makes a move, like you can see there, 2021 or 2012 to 2015, big move. How about 2003 to 2007? You go through what can be multiple year runs in Goldman Sachs. And after consolidating for a couple years, it could be right for that. So what do you look for? Number one, we want to get that breakout above 400. Number two, I'm liking the fact that Goldman Sachs is leading the investment services peers. So that's good. And then this is kind of going to be a key too. I want to see investment services begin to outperform the S&P 500. Again, if you want to outperform, you need to be investing in leaders within leading groups. And Goldman Sachs right now, I think, is becoming a leader, but it needs that breakout. What that breakout tells us is that money is rotating into investment services. And if I get that kind of a signal, along with knowing how Goldman Sachs trades, I think this could be a stock that does extremely well in 2024. But I'm waiting for the triggers on the stock. All right. What else? Well, it is after 9:30. Let me just show you real quick a couple of things. I have industry group relative strength chart lists at stock chart. I keep them at stock charts, but we do this at EarningsBeats.com, and we make these available to our annual members who are also stock charts members, because we use the platform at stock charts. And if our members use the platform, then all of our research that we do where we keep chart lists can literally be downloaded into our members' stock charts accounts in seconds. I could work on something for 300 hours, put it together, tie it in a little bow in a chart list, and a member can download it in about 5 seconds. All of my work. So there's a lot of beauty. Now, this is kind of a static chart list. It doesn't really change unless the number of industry groups change. There's 104 industry groups. We got this set up, so it just keeps changing, keeps providing us the information as we go. We don't have to change the chart list. So anyway, here's healthcare providers group, and you can see there's the relative strength, which has been going down. It did hold the August bottom, though, and it's starting to turn back up. And notice that it just hit its 52-week high. So this is a group that's starting to strengthen. It's in the defensive area. I think right now, if I'm going to be trading in this kind of an environment, I kind of like the defensive stocks because they're showing relative strength. If they do pull back, they're probably not going to pull back big. They're not the types of stocks that lose 10, 20% a couple days or a week. They tend to pull back a little bit quieter, if you will, but they're just starting to get going. Like the healthcare providers just breaking back out to a 52-week high after going sideways for more than or close to a year. So this is a group that I would be interested in. But I mean, I could go through all of these, but here's the next healthcare. This is medical equipment, and you can see since November, medical equipment actually is showing some nice strength. Still got some work to do to clear the July high, but it's certainly been improving. I would say it doesn't look as good as healthcare providers, but it's looking better. Pharma's one of our leaders yesterday. Look at this big level up here at about 860. We went up over 840 yesterday. We're getting very close. A breakout there would be really bullish because it likely would lead to a move in the relative strength above the 20-day. Anyway, I could go on and on about these. I'll give you one in the consumer staples area, food products, which was one of the top groups yesterday. Here we go. Food products, double bottom, actually triple bottom on the relative strength. So this is an area where you would think money would rotate back in, and it has started to. And you can see coming from a multi-year low on an absolute price basis, this group has been moving, but it's still got a long way to go to get back to its high from May of 2023. So food products is an area. It's not sexy. It's not going to be a fast mover. But if you're trying to protect capital and maybe have a little bit more of defensive influence in your portfolio in the short term, while we try to figure out where technology and some of these other areas are going in the short term, I think areas like food products make a lot of sense. Anyway, let's take a look and see what's going on in the market. We have now opened. We got the Dow down 157, S&P down 23, NASDAQ down 84, all down somewhere around the 0.5%. A little bit more on the NASDAQ, a little less on the S&P and on the Dow. And then we got small cap and mid caps getting hit pretty good today, down 1.5%. With the VIX up 5% to 1390. The VIX, I think, probably could get up. I mean, if we really had a decent pullback, I could see the VIX as high as 16, 17. But that's short term. It's still below the 20 level where the market can still do extremely well. I think once this period of selling kind of exhausts itself, we get a little bit of profit taking. I believe we're going to see some more strength coming up. How much strength? Well, join me first tomorrow, January effect, 4:30 p.m. Eastern, and then on Saturday for Market Vision 2024. Again, if you go over to EarningsBeats, you'll find it right on our website, EarningsBeats.com. Really appreciate you joining in. Thank you so much for watching. Like the video, and if you're listening to the recording, make sure you like that video, and please subscribe to our channel. It really, really helps us at EarningsBeats. Again, if you can't subscribe as a member, whether it, for whatever reason, I'm not even going to try to guess what the reason is, but if you can't subscribe as a member, you can certainly still help us by clicking on that like button and subscribing to our channel. Have a great day, everybody. I'll be back tomorrow for your next Trading Places live show. And in a half hour, I'll be getting together with our members with a live trading room. And we're going to talk about some of those defensive groups. That starts at 10 a.m. Again, trial membership gets you into that as well. And that starts in just less than 30 minutes. I'll see you there. Happy trading, everybody.